So good morning, everybody. I hope you can hear me well, loud and clear, and you can see the slides well. I understand that that is the case. Today, we will talk about accelerated book building offerings, ABO. And but before going to these topics, I wanted to propose to you to refresh all the key concepts associated with the green shoe mechanism that usually creates a bit of confusion and questions, around, among students. If you agree, I would love to, go through the green shoe mechanism once again, and then we start with this session. I hope that is okay for you. Any answer to give me some incentive to proceed this way? Okay, sure, perfect. So I wanted to make sure, because I understand all the other concepts in an IPO are relatively straightforward. I wanted to make sure that also the green shoe mechanism has been properly understood, digested by you. And that's why I wanted to, refresh on the concept. When there is an IPO, there are three main players. Try to visualize this concept. We have the selling shareholder, that de facto could be the company Prada, could be Ferrari, could be shareholders of Fiat, actually now Stellantis, and so on and so forth. Then you have the global coordinator, and then you have the consortium, and then you have the market. The way it works the green shoe is that when there is an offer, an IPO, global coordinator will offer through the book building process and the allocation. They will offer two things: a base offerings and the green shoe. In total, for the benefit of the discussion, 115 shares divided in 100 as a base offer and 15, which is the green shoe. How the global coordinator and the consortium can offer, allocate, and then sell to the market, to the investors in an IPO, 115 shares. How they get physically the availability of the shares. As far as the base offer concerned, 100, they will buy at discount to the IPO price. They buy, in order to include the gross fee, they will buy the shares from selling shareholder. While the 15 shares will be only lent to the shareholder, to the global coordinator of the consortium. De facto, these 15 are subject to a borrow agreement, okay? So they borrow 15, they buy 100, they get physically 115, and then they allocate and sell it into the marketplace. What happened then afterwards? When the company starts trading, usually is a Monday, there are two cases. Either the share price goes up, and in this case, there is no need for the global coordinator to do anything special because the market is reacting well. There is additional demand on the institutional investor side. And basically, if there are investors that are selling, as a result of the oversubscription that we have achieved during the allocation and the book building process, there are outside additional layers of demand that they more than compensate some additional selling pressure that could take place in the market. So the price goes up, and what happened? after the month where global coordinator and the market agent needs to provide support, you see that the price went up, you have cashed in the sale of 115 shares, and what do? You close the sale agreement with the selling shareholders in cash because you've sold the shares, and you close also the borrow agreement with the selling shareholder in cash because you have sold the shares. The price went up and you don't have any shares left. So that's the easy case. The more complicated one is when the price after the IPO, in the first day of trading or in the month following, the 4 weeks of trading following the starting date, the share price deflect, goes down. If the price goes down, the liquidity market agent and the global coordinator orchestrate, some support in the market in order to provide the market with an healthy, liquid trading activity. So they buy shares every time there are sharp reduction in price because there is too much offer and not enough additional demand in the marketplace. So de facto, they buy shares, and when the market, to support the price, and when the market, closes after 1 month of the support, you are in a place whereby you have sold 100 shares in the marketplace, and you have used the green shoe mechanism that were 15 shares that you have available to be bought back in the market. In other words, global coordinator can support the market by buying shares in the marketplace, up to 15 shares. And after the month, what they do, if they bought this share to support the price, they close the agreement with the shareholders as follows. For the base offer, they give them the money to the selling shareholders because it's a sales purchase agreement, and de facto, you give it back the money as a total consideration. On the contrary, the 15 shares that were subject to the borrow agreement will be returned in kind, and you close the borrow agreement by returning shares to the selling shareholders. So when the market is performing well, de facto outside there are 115 shares that are trading every day. Okay? On the contrary, when the market didn't react well after the IPO pricing, as a result of the aftermarket support that the global coordinator are performing, there will be less shares in the market because a portion of the shares will be bought back and returned to close the borrow agreement to the selling shareholders. Do you have any questions? Clear, excellent. Anybody else? Don't be shy. I know that in this format, remotely it's complicated to have an interactive session. I'm very frustrated, but we try our best. Everybody is okay with this mechanism? All good, excellent. So let's talk about now what happened in the market. Yeah, they will buy back up to the green shoes. They cannot buy more than 15 shares. It could be up to the green shoes. Question for you. If the price declines, it means that it goes below. No, it cannot be. No, it cannot be. A student ask if these things can be considered a legal market manipulation. For sure is legal. It's not a market manipulation per se, but I agree that there are buyers that are devoted in their own assignments to buy shares, okay, because there is a duty. So you manipulate a bit the market because there are natural buyers because of a duty, not because of their own decision. And it's legal for sure because it's the only case where market maker can buy the shares on behalf of others based on a contract and based on understanding with the regulator that scrutinize with this activity in the marketplace. For us is in Italy Consob, and this is allowed. Is the only month after the pricing of the IPO where market makers, the global coordinator, can buy the shares in full transparency on behalf of, for the transaction with the blessing of the regulator. Otherwise, in any other part of the business activity, they would be not allowed, okay? So they buy the shares because there was a contract. Buy the shares, at loss, de facto. What happened, if I do an IPO at 9, the price goes down at €9 per share. The price goes down, so I start buying at 8.80, 8.70, 8.60, whatever it is. So I buy below the IPO price. What happened to the difference between a €9 per share and the price where I bought back shares and I closed by delivering back to the selling shareholders the borrow agreement? What happened to the difference, in your opinion? Difference in price, that capital de facto gain. I sold at 9 and I bought back at 8.50. Yeah, it is a profit. So what happened to the profit? Where does it go? It's not going to go for charity for sure. Brava Chiara could be global coordinator, or, as Lucas proposed, could be given back to the selling shareholders. Has to be regulated by the underwriting agreement. In the underwriting agreement, in addition to the green shoe mechanism, the fees, and so on and so forth, you also regulate how manage in case there is a profit, the destiny of this profit. Usually goes back to selling shareholders, but there are cases where the shareholders agree to share this profit with the global coordinator. Okay, if there are no more questions on the green shoe, I will start, the follow-on equity offering. So today we will talk about what happened in the marketplace once the company is born as a public entity, okay? So the shares are traded in the marketplace, the company publishes results, research covers the company, there are news flows about the company, so the market trades shares every day, buy side, sell side, market maker, hedge fund, long money only. All the markets is active in trading those shares. So the baby is born and is alive because the shares are traded and they're liquid in the marketplace. What happened? What happens afterwards? So while the IPO is the initial public offering, so de facto is the first time that the shares are offered to third party, to investors, and the company faces a new life, which is I move from private company to public. Once it's public, the life is totally different. And you remember we made the case of Prismian, where the IPO was in May of 2007. And then let's see what happens. Let me tell you, in November 2007, you can see on the left top inside, was just before the financial crisis that has been consummated in 2008. So clouds were gathering in the horizon, and Goldman Sachs decided that, you know, it is important to accelerate the exit strategy. And basically, on November the 6th, Goldman Sachs made 2 transactions in the market. And I want you to go on summary observations on the right-hand side, on top where the graph is. The 2 transactions were the following. On one side, Goldman Sachs Capital Partner sold 22 million shares, equal 429 million euro, through an accelerated book building offering. We're going to go into the details of the accelerated book building offering in a second. And together with this accelerated book building offer, Goldman Sachs also announced the sale of 17.8 million shares, equal to 392 million euro, at 22 euro per share, to Taiwan Electric Wire, a South Korea company that operates in the cable business in Asia. So what I'm trying to tell you is that there was a 2 transactions. We sold a de facto 400 million shares, 40 million shares, I apologize, 22 million into the marketplace, and almost 18 million to this Korean industrial partner. And you can see that an anomaly. In the same days of November the 6th, there were 3 prices in the marketplace. You got the price of the shares in the market that are daily traded, you know, and exchanged between the market players. Then there was the price of the accelerated book building, the 22 million shares that have been sold at 19.35. As you can see in the transaction summary on the left-hand side, you see price 19.35. And there was the price at 22 per share for the 18 million shares that have been sold to the South Korean player. Here again, by looking the transaction summary, we go through detail. So the size of the offering was 22 million shares, and was an accelerated book building offering. The selling shareholders were de facto, you know, the Prysmian Luxembourg, the holding company that used to have all these shares, the shareholders. And we sold secondary shares, so shares already existing, outstanding, at the price 19.35. That was a discount of 0.56% to the last price recorded in the market, which was on November the 5th. And the selling shareholders agreed and commit themselves to respect a lockup of 90 days, this is the last information, before selling new shares in the marketplace. So here you have an accelerated book building offering, which means an offer that in size is important because it's 430 million euro, 22 million shares, executed in only a few days, offered to market at a slight discount, 0.56. As I always told you, when you do an equity deal in the marketplace, you need to offer a discount. In this case, the discount is to the market. While if you remember, when we have done the IPO, that is not an accelerated process. The IPO lasts 4 to 6 months. The shares were offered to discount to Nexan, which is the peer in the marketplace. At the same time, we also offer almost 18 million shares to this South Korean player, but in this case a premium, because we sold it at 22 euro per share. In your opinion, why there is this anomaly? The same day, three different price is an anomaly from an academic standpoint, that for the same shares, you got three different price. The price in the market, the price that you offer the shares to investors for the accelerated building at discount to market, and the third price that is a premium to market, 13% premium to this Korean. In your opinion, why the Korean wanted to pay a premium? No, it was not a control, because as you can see, they bought only 9.9%, and Goldman Sachs Capital Partner still has the majority of the company. But we are getting there. It's not a proper control, as suggested one of the students. No, it's not private benefit in this respect. You know, it's not because we offer helicopter rather than, you know, parties. You know, well, we are going in that direction. So the fact, I would say the combination of significant influence and synergies. They were ready to pay a premium because we started in Prismian a cooperation with the South Korea company, okay? Cooperation in Asia in the cable business. So for them was important to have you know, they were ready and prepared to pay a bit more than the market, because there were discussion very well advanced on how to cooperate in the cable business. But also there was the concept of significant influence, because significant influence means that they got offered seats in the board that, as you can appreciate, are not offered to all the normal institutional investors. So for all these reasons, also in these accelerated book building offerings, we respected what we said are the academic, you know, key points. You always offer to investors equity shares with a discount, in this case 0.56, but we have also seen that shares can be offered at different price when the trades are in nature different, because there could be a bit of synergy, there could be governance attached to it, and in this case you can find in the same day all the possibility: discount to market, the market, and also the premium to market, because of the strategic you know, buyer in as a core group investor. As you can appreciate, the level of the discount was very tight, also because the offering of the back of this news of the 10% sold to the Korean supported a lot the equity offering in the market share, in the marketplace. Okay. Then, unfortunately, and I remember very well because it was a pretty sad and scary period of my professional life, 2008 passed by, you know, as one of the worst years in investment banking, but not only in investment banking, because all the markets were shut down, there were no transactions, there was no activity, and you know, all banks were under severe pressure because of lack of liquidity, and so on and so forth. As soon as the market reopened, we decided to accelerate and continue, you know, the exit strategy from Prismian. And guess what? On November the 10th, we made another accelerated book building, the book building number 2, where we sold 26 million shares. This time the price was neither 19.50 like the previous one, nor 22, the price that we sold to the Korean, but look at the price, was 12 euro per share. 12 euro per share, so was was reflecting very clearly the new market condition in the marketplace. And again, they were ordinary shares, secondary offered to institutional investors with the 144A, the eligibility for qualified investors in the US as well. Also, this transaction was subject to the lockup, 60 days. And in this case, we use only Goldman Sachs as a book runner because we don't need the legitimation and all the other formal protection for investors, because now the company is a publicly traded. Everybody knew the company. It was already 2 years after the IPO, so we don't need a big consortium for such a transaction. And also in this case, we place the shares with a discount that you can see here in the graph. Okay, so that was less controversial in terms of structure because it was a simple accelerated book building offer in the marketplace. Now, what I wanted to talk to you is another case that in my mind is very interesting, and is the Nexi IPO. We don't go through again the process of the IPO. We talk about the transaction only. And because it's very interesting also in terms of, exit strategy. I like very much this case, Nexi, because Nexi was executed in 2019, was an IPO of 2.3 billion euro, that at the time of the transaction was probably one of the biggest transactions in Europe, but for sure the largest equity offering in the marketplace as an IPO after the privatization. So it was a massive transaction. And Nexi is a player, is a pay tech company in Italy that is born through a number of acquisitions executed by a group of private equity, Bain, Advent, and Clessidra. All together, they set up a company called Mercury Holding, and together they made acquisition of bits and pieces of a pay tech company in Italy. They put all together all these assets and ultimately created Nexi. How it happened that a private equity managed to buy different company in the market, in the payment business, and create, at the time, the largest player in the payment business in Italy. You need to go back in those years where banks, not only in Italy, but in Europe, were under severe pressure because of the capital position. There was, the long tail of the crisis, of the financial crisis. Credit exposure was extremely severe for banks. Regulator decided to reduce the leverage, to increase the equity base of banks in order to protect the system, because nobody wanted to experience again the crisis that we have experienced in 2008 and 2009 in Europe. So banks were very, very, very severely under pressure to raise capital and to raise equity. There are two ways. Either you do equity offerings, but also asset disposal. And guess what? In Europe, like in US as well, most of the banks decided to sell what was a very interesting opportunity at the time, to sell the payment business or portion of the payment. When you do a payment, it's very simple. You need to think about like an oil pipeline or electricity pipeline that goes from the generation to the consumer through the pipe, through the cable, and in each part of the cable there are different phases, and in each phase there are a fee that is being paid to the provider of this phase. Until the payment chain was totally integrated in a bank, we didn't see all these fees because were internalized by the bank. So from, when you go to the restaurants and you pay, for example, for your own dinner, you use the credit card. While you use the credit card, there is the code, recognize the card, instruction to the payment company to recognize the card, green light to execute the payment, money gets away from your account, then they will be asked to enter another account. On the other side of the account, which is the account of the restaurant, there is another green light, settlement procedure, and then they see the money on the other side. In order to transfer this money from one side to the other, as I told you, there are different phases, and originally they were all internalized. Banks, in order to raise capital, they sold the bits and pieces of these phases. And why they sold them? Because there were no capital attached to this asset, to this business, and they were not considered proper banks because this is more an infrastructure. So as a result, these assets were not heavily regulated like banks. So by selling this piece of business, they could sell this business like a corporate, and indeed are traded and sold in the marketplace with EBITDA multiple rather than price earnings. So they are not sold or price to tangible book like a bank. They are sold like a corporate. So was a source of important capital gain from banks. And the private equity that are not regulated by BCE, by the central bank and the Bank of Italy, they were able to create capital for the banks and buy this asset with good leverage and with a good price. And those assets are extremely interesting because they're growing very fast. Think about it. While in Scandinavia, 92, 93% of the payment are done through credit card, electronically. In Italy, this percentage is only 60%. So the potential in Italy for increasing the number of payments that are done through credit card, to debit card, electronically is massive. And the private equity, they saw this opportunity to do so. So Nexi is born by collecting together assets, and after 2 years of acquisition, Nexi was ready for the IPO. The way we presented the story in the marketplace is highlighted in the equity story pillars. So the payment is large and attractive. Nexi was the established market leader with a strong partnership with the Italian banks, because one way to distribute the payment and the credit card and in order to provide the security into the pipeline in order to guarantee the payment from A to B, of course, you need to have the partnership with the banks. So this partnership was important to reassure investors that the infrastructure was there for years in order to perform business. They had a very important product with a lot of growth opportunity. Technology wise, the company was extremely attractive. And finally, a very strong management. So as you can see here, also in the case of Nexi, in 2019, the key points of the equity stories are always the same. Good story, growth opportunity, strong management, and undisputed market leadership. So the company is good and can be presented to the marketplace. Let's walk through the typical features of the offer. The base deal was 223 million shares. So you remember when we explained in the first place the green shoe, we said 100 are base and 15 are green shoes. In this case, the 100 is 223 million shares. And the offer was 35% primary, so a capital increase into Nexi, and 65% was secondary shares sold by the private equity. Green shoe, 15% of the deal, base deal size, all secondary shares. Why secondary shares? I want you to know this. Please be focused. The green shoe per se can be only applied in IPO with the secondary shares, because there is no point that you apply the green shoes in newly issued shares for the capital increase, because it's like to say, I offer new shares because I need money into the company, but if the price goes down, I buy back the shares into the market, okay? And basically means that I reduce the capital increase. It doesn't work for the primary shares. You need to execute the green shoe to stabilize the market only with secondary shares. So shares borrowed by in this case, Mercury, by existing shareholders. So otherwise, when you close the borrow, you return to the selling shareholders. In the case of secondary shares already existing. But if they would have been primary, you issue shares and then return the shares, which is counterintuitive. Doesn't make any sense. So it is important, even though it looks like a small detail here, but I want you to remember that the green shoe can be applied only on secondary shares already existing. Offer structures. We offer to qualified investors with the rule of 1448, which is de facto, the rules in order to make the offer eligible to American investors, and normal regulation as outside the US. Selling shareholders, as I told you, Mercury holding company, which is the company controlled by the 3 private equity. And we price the shares at €9 per share. And here you can see, as a result of the book building process, the range was 850, 1035. Then we revised down to 9 to 950. We create the book building. We created the book with this very narrow range, and then we price at 9. We price very cautiously at 9 rather than a different price, because also in the case of Nexi, there was a high concentration level of high quality investors, and at €9 per share. Marketing timeline, you can see here, we made a pre-deal investor education, and you know what I'm talking about. This is the testing water exercise that you do with investors before launching the transaction. Then we went to road showing, presenting the market, the management team, and we start the book building between March the 29th and April the 10th, pricing on April the 11th, and start trading on the 16th. Here you can see the additional clauses of the lockup and the member of the syndicate. We were global coordinator Goldman Sachs, jointly with Credit Suisse and Bank of America, and 2 Italian banks, Banca Intesa and Mediobanca. So that was the IPO Nexi, and in order to be selected, there's been a beauty contest made by the private equity. I remember that we, like other banks, there were 2 days of beauty contest. Beauty contest means you go there and you try to win the award of the mandate by trying to show all your beauties, okay? Which means in the case of an IPO like Nexi, the discriminating factor, in my opinion, was the team of fintech that was probably one of the best in the world. Our team in fintech is very good, and it's important to shape, elaborate, refine the equity story in order to help the management to tell the story to the market. Second element was the distribution capability. To reassure the private equity, the selling shareholders, that we will be able to sell the shares by using the distribution platform of the bank that is unique. And of course, there is also the element of valuation, because we propose some valuation range when we made the pitch. And trust me, we were relatively prudent and cautious compared to others, because in the culture of the firm, we want to always be optimistic, visionary, but also very much attached to the solid ground, without avoiding to sell dreams, because the IPO is a long process and there are always, uncertainties and potential best surprises around the corner. So you don't want to go and say, this company that at IPO has been valued by the market around the $6 billion. You don't want to promise $12 billion or $10 billion promising big valuation. You want to be very much attached to reality. And I remember our pitch was less aggressive than others, but more related to very high, solidly demonstrated assumption that apparently made the job. So we have been selected, and with all the other banks, we made the IPO. So April 2019. Let's see. Again, a speed of allocation. As you can see in IPO, we privilege the long-only money, 75% in the bottom right, versus the hedge fund, only 25%. And in terms of geography, we de facto sold the offer in all jurisdictions in the world. This is an important information because we will see later why. So after April and after the lockup expired, in January last year, the 10th, we made the first accelerated book building. So the Mercury, the company that is controlled by the 3 private equity, as Goldman Sachs capital partner made in 2007, so accelerated the exit strategy, the funds made the same. Which means they decided to go again in an offering structure 100% secondary. So they sold the shares already existing. We went regulatory S in Europe and 1448 for US. And no proceed to the issuer because Nexi didn't need money. All this money went to the selling shareholders. And remember, we sold in IPO the shares to the market at €9 per share. Now the pricing is 11.60 per share with a 6.3% discount to the previous closing price. Look at the graph. You remember the company is being presented into the marketplace as a company growing, cash generating, leader with no credit exposure, not a bank, but a corporate with a strong infrastructure from a technological standpoint, so a fintech. And look at the price performance. In April, the blue line is Nexi price. So the 100% was €9 per share, went down right after the market, right after the starting, the IPO trading activity. Then quarter after quarter, Nexi went up, and the price performance, the share price performance of Nexi was 38% compared to 9.7% of the index. As you can see here, this company easily outperforms the stock market. So basically, we offer with a discount of 6.3%, again the same rules, and this time around has been sold more to long money, 53%. More balance in terms of jurisdiction, but the component of hedge funds increased at 47% of the total offer. What I wanted to share with you is an executional highlight. You see in the right-hand side of the page, the first line is effective pre-sounding exercise. I wanted to share with you a technicality that we use in the marketplace to organize this accelerated book building offer. If you remember, when you are in IPO, to test the water, what you do is an education, pre-deal education of investors about the company. You do meetings before launching the transaction, to say, that's what we want to do, this is the equity story, that's the valuation. And you get the feedback from the investors in order to factor in all this feedback, in order to, adjust price expectation, the price range, and the offering structure in order to meet, the favor of the investors in order to pay the way for a successful transaction. But when you go public and you have done the IPO, you don't need to educate investors any longer. So it doesn't make any sense to do a pre-deal investor education exercise, because investors are educated, because they have new flows in the market. They can see on a quarterly basis the number of the company, because it's listed, and they publish quarter by quarter their own financial results. You have research, you have trading activity, so investors know about the company. So how we can test the water in order to make sure that you do a transaction of 562 million euro and you make sure that it goes well? You do de facto a wall crossing exercise. What is a wall crossing exercise? Basically, the wall crossing procedure is when you take an investors on this side of the wall. And basically, you allow the investor to cross the wall and become one of the members of the private holders of information. So de facto, you call a highly selected number of investors. You call them. You tell them that there is a transaction that could come up in the marketplace in a few days' time. And if they want to know more, there is a non-disclosure agreement to be signed. If they want to be involved in the transaction and they want to know more, they sign the non-disclosure agreement. We unveil what we have in mind, and they are technically wall crossed. So Fidelity, for example, from being an institutional investor that has only public domain information, immediately, as a result of the signature of the non-disclosure agreement, goes into the wall, and it becomes, owner of a private and confidential information like an investment banker. Once they cross the wall, they are with us, they work with us for a couple of days, no more than that. We share information like we want to sell, 24 million, 7% of the capital, 7 to 8% of the capital. That's the price that we have in mind. We want to sell a secondary offering, so no more additional shares in the market, no primary. So you explain what you have in mind, and the reaction of the investors that has been wall crossed could be twofold. Either they say, you know what, I like it. This allows me to round up my position or to enter into the stock. I like, the price range. I like the structure, but I want the price range a bit wider. They like the idea. They help you to shape the accelerated book building offer. And guess what? When they say, okay, if you structure the transaction as we discussed, we're going to be there. So the day after you launch the transaction, and you can rely on the presence of those investors that have been already pre-alerted, pre-wired, pre-involved, and usually the transaction flies flawlessly, because on the back of their own support, the market follows and you execute the transaction. On the contrary, if the feedback is negative, in other words, they say, you know what, I'm already long of those shares. I think I would love to increase my exposure, let's call it in a few quarters down the road, because I want them to cement their own position and create a bit more consistency in the delivery of the results. It's not the right timing. The discount is too low. Whatever is the reason, if you see that those investors are not very much inclined to support the transaction, then you need to do what is called the cleansing activity. Basically, you take into account their own point of view and you say, okay, I postpone, I put on hold the transaction, I'm not going to do it. And you can return on the other side of the wall and become again public. But because they had this information, you need to cleanse them. You need to clean them up. And basically, the procedure is the following. For, let's call it 6 months, this transaction cannot be reproposed once again into the marketplace in order to allow all the investors in the market to play once again a playing field level, because nobody has no public information. So the wall crossing is you put investors in, signature of the non-disclosure agreement, you unveil the transaction. If they agree, you launch it. Otherwise, you put on hold and you allow them to cleanse by allowing the time to pass by for let's call it 6 months, in order to have all the market once again at the same level. Do you have questions on the wall crossing activity and the accelerated book building offering? Everything is clear. Are you still there? No, it's clear. Perfect. Perfect. So this transaction was January the 10th. Look at what happened a few months down the road. In May, we made another accelerated book building. Okay? And again, that was even more, how can I say, unique. May, while the transaction in January was just before the lockdown for the COVID-19 virus, in May we were in full lockdown. And I remember that this transaction has been pitched, executed, allocated, and distributed totally remotely online. Let's look at the transaction. This time around, the share price was 14.2 euro per shares. Again, 7.2% discount to the previous closing price. So again, there was a discount. And the lockup, 90 days, like last time around. And you can see the performance of the stock was very much reflecting the market condition and the superior performance of the company as well, because the line blue goes from 9 euro, and you can see that was up until the end of the year. Then there was the sharp reduction in price due to the market collapse during COVID, but then the company recovered soon after for a very simple reason. It was not the typical company that is affected by the COVID, or not as affected like other company. I mean, during the restriction, you don't travel, so company airlines de facto were very heavily affected. But during COVID, you keep on paying your own food, you keep on paying for your own books, and actually the digitalization of all the jurisdiction increased dramatically during COVID. So de facto, people use more credit card and debit card for their own payment rather than using cash, because it was, from a sanitary point, illegal. And guess what? The volume on Nexi went up. So when the market realized, what's the point to put under pressure the price of Nexi? Nexi actually will benefit of it, because we know that the penetration of the credit card market and payment online business in Italy is only 60%. We'll go closer and closer day in, day out to the best practice of the Scandinavian market. So when the market started to realize that actually, Nexi was a winner out of this, reshuffle in the market and crisis due to the COVID-19. You can see from February onward, the share price went up again, the line blue, while the market in red was down 18%. The share price of Nexi was up 20%. On the back of this relatively improved and good, framework, the fund decided to do another accelerated book building. We had done again wall crossing procedure, and we took benefit also of the transaction that that Nexi made with Intesa. They bought another piece of payment business from them, and they also sold them 10% in order to cement the relationship. Now Intesa is a key shareholder of Nexi. So on the back of this, and this is a good news because all the shares that the market is expecting to be sold in the marketplace from the fund, because they went 10% to Intesa, reduce what we call the overhang on the stock. They reduce the offer potential of shares into the market, and that was very much appreciated by investors, because they said 10% of the shares that the funds wants to sell, they're not going to go into the market, create oversupply, but they went straight to one of shareholders, which is Intesa. So the discount was 72%. Again, the wall crossing procedure. And here you can see a different allocation, because there was the IPO in April 2019, then the first accelerated book building in January, and then this one was the second accelerated book building in May. In 1 year, a lot of money went and shares were into the market. You can see that the long money investors, so the investors that usually take a long-term view on the stock, were now a lower proportion of the total allocation, because they were already long of stocks, while hedge funds, they were more attracted by the high liquidity of the stock, the growth opportunity and potential of the stock, and they were on a relative basis more presence in the demand. And finally, another 1.3 billion accelerated book building on Nexi in October. If you notice, while the global coordinator were Goldman, Credit Suisse, and Merrill, for the IBO in January, let me see, the global coordinator were Citi, Goldman Sachs, and Barclays. I'm talking about the foreign ones, because Mediobanca and Amy were always present. You can see that there was a shift, because this time around, Merrill and Credit Suisse were not involved. And Citi was involved, and Barclays, because they had very good research, Barclays, on the payment business, and the Citi because they have a very good equity syndicate platform. So out of the book runners and global coordinator of the IPO, only Goldman Sachs remained involved in the first IPO, in the first accelerated book building. In the second, in May, again, the same banks, but this time around there was also Hong Kong Shanghai Bank for the same reason. Very, very good research on the payment business. And for the third IPO, the same structure. Why I'm showing all these things, the banks that are there? Because I wanted to share with you an important concept. All the products in equity, but all the transaction in investment banking are important, because when there is a transaction, the transaction creates a sort of earthquake, is a catalyst for a number of things that will happen later. So all the transactions are never, never, never an isolated event. Here, for example, there is an IPO. We were in the IPO, but to be in the IPO and to be a good bank allow us to take the accelerated book building offering in January, in May, and in October. And guess what? You made money in the first place with the IPO, but because we keep on trading the shares and we knew who wants the shares, who wants to sell, we read the market all the time in a very, very professional way. We managed to become the most important trader in the Nexi shares, and that paves the way to get, you know, more business going forward. So you don't do only the money in the IPO, but you do money also in all these trades where you have a league table, we have fees, we have the possibility to make additional money. So what I wanted to tell you is that investment banking is a very unique business whereby every time there is a transaction, the team needs to be very much alerted, very much laser focused on that client, because when there is a transaction, there will be the implication of it. And in this case, where the three accelerated book building offer, it could be a convertible, and we're going to talk in the section of the convertible in the day to come. So in other words, there are so many other transactions that, you know, you keep on making money with the same client and making transaction. Here, the price was 15.5 per share with an 8% discount. And look at the stellar performance of Nexi because of the acquisition that they were performing, and also because transaction after transaction, the company became more and more publicly owned because the private equity went down something in the region of 20% of the market in terms of ownership. In the meantime, Nexi announced other two transactions where we were involved as advisor. The merger with Nets. Nets is the equivalent of Nexi in the Scandinavian market. So now Nexi is a European player. And also the merger with SIA, that is the very much B2B player in the payment business in Italy. Combining with the Nexi that is more retail, they create a unique platform. So they are now the #1 undisputed leader in the payment business in Italy and also in the Scandinavian market. Guess what? The market cap of this company now is north on a pro forma basis of 20 billion euro. Okay, there are days that could be 20, 22, 23, even 25 billion euro. And there is one of the most important financial institutions in Italy. Think about it, only Intesa has a value more than Nexi in Italy. And Nexi, as a payment company fintech, is almost equal to the sum of all the other banks, Unicredit, BPER, Monte Paschi, and so on and so forth. So it is a clear evidence as, you know, change ownership structure from banks to private equity created value in the first place, number of acquisition, exit with an IPO, accelerated book building, keep on going with the M&A strategy by buying SIA and also merging with Nets. And now the strategy is, at least for a couple of years, completed or in almost completed. And, you know, the management and the fund have created one of the best players in Europe in the payment business. You know, I wanted to share these things because it can, you know, shows you as investment banking is a recurrent business that you need to chase with the same clients, because once there is a transaction, there are a lot of transactions coming afterwards. IPO is a product that is profitable in the first place, but paves the way for future profitability, because it is an important thing to go from private to public. And if you stay close to the client, you pave the way for future business going forward. And also, this transaction was very important to show and share with you the key takeaways of what happened in the financial market and in the banking industry over the last few years. A shift from traditional banking into fintech, not only in value, but also in size and volume, because the market is changing. And I remember when I joined Goldman Sachs in 2006, the business in the financial institution group was, let's say, 70% in banking traditional business and 30% in insurance. Now fintech, that was not existing in 2006 when I joined Goldman Sachs, now represents almost a third of the revenues that we do in the financial institution group. So the world has changed dramatically, and Nexi is a typical evidence of how much it's changed, because 5 years ago, in 2015, Nexi was a small company, a bunch of assets, and now is a market cap public entity of 25 billion euro. I would pause here. I would love to have a question for you if you have a doubt, concern, issues that you want me to address. Otherwise, we finished and we see, I think, tomorrow. But please, do you have questions on this session? Please, Andrea.
Sorry, Professor, can you hear me?
Yeah, I can hear you very well.
Can you hear me?
So,
I just wanted to ask if, for example, we have seen a lot of examples of successful IPOs from different banks. The only thing we still don't see, in my opinion, is unsuccessful IPOs and operations. In order to learn from the bank mistakes or from market conditions that happened. Do you have any examples of unsuccessful IPOs or operations that you can share with us? Thanks.
No, okay, very clear questions. You need to consider that the IPO is made by professionals, and usually when a company goes IPO, when it goes public, by definition, sooner or later is a success, because if you launch the transaction, is because you have reassurances that this IPO will fly, okay? When an IPO doesn't have the characteristics or doesn't seem to be successful as a transaction, you have the possibility to stop the transaction before going public. As we have seen, we have these phases of the pre-investors education, pre-deal investor education, that are aimed exactly for this point. You test the water, and if the water is not nice enough, you don't launch the transaction, because you don't want to have an unsuccessful transaction. So generally speaking, an IPO, when it goes, is because the syndicate is confident that can be launched, and usually is successful, because you mitigate and hedge the unsuccessful case of an IPO beforehand with the pre-deal investors education exercise and with all the preparatory work. But of course, there are transactions, like I remember I worked on an IPO of Sole 24 Ore. The IPO went into the market, so was completed, but in my opinion was not a successful transaction because the retail component was very high, the institutional demand was very low, and this is a very clear sign among professionals that the transaction was not particularly successful, because it was an IPO that we needed to do for institutional reasons. Sole 24 Ore needed to be listed, and even though it was a company, not because of Sole 24 Ore, but in an industry that was not attractive, we knew that it would have been a complicated transaction. So, and the evidence was a very modest institutional demand. Third point, you can have also what they call unsuccessful kind of IPO, even though they fly in the market, maybe because they fly too much. You remember for sure when there was the IPO of Facebook, that the price went up dramatically, skyrocketing, and everybody was complaining that the pricing was not properly defined, and so on and so forth. At the end of the day, I must say, when there are companies, especially in a changing world, and you have this online player where you don't have precedents, you don't have benchmark, you don't have peers, and so on and so forth, it's very complicated to price an IPO, and it could be defined unsuccessfully executed, even an IPO that was extremely successful because the price went up dramatically. But people were upset because the Facebook price at the IPO was, let's call it 100, and was already at 250 after a few days of trading. So I hope I replied to your question properly. Okay. Any other questions? So one student is asking me, I don't understand the role of joint book runner. Let me repeat again. In order to have the credit on the league table, you need to have the title of joint book runner, which means you are entitled to run the creation of books. You control the book. Once upon a time, when we sold shares in the marketplace in transaction, the book was in paper, and you register order like in an old hotel. There is the visitor, write the name, and check price and quantity. Now you do everything electronically, but still you need to run the book. Basically, book runners are the institutions that are running the show and are running the creation of the books. You need book runner because you need someone to lead the transaction. So the joint book runner is the most important role in a syndicate because are the banks that are entitled to run the books and they get credit for this job. Sometimes you can have the anomaly that the global coordinator are not book runner, and I made the case with Prismian because there are situations that are so unusual that a bank, even though it's a global coordinator, doesn't have the book. But to get credit and to run a transaction, you need to be a book runner. So de facto is the first violin that plays the music in an orchestra. Without the first violin, there is no music that you can play, at least on classic, when you have an orchestra. Okay. Yes, there was a question. What is the definition of IBO? Is accelerated book building offerings, ABO. Lockup is a clause where selling shareholders commit themselves to not sell shares for a period of time, usually 90 days, between the transaction and the next one, in order to allow the market to digest what you are offering. So you lock up yourself for 90 days and you say, now I want to sell 100 shares, and I lock up myself for 90 days before selling another lot. So in order to provide guarantee to the market that there will be an oversupply of shares after the transaction. No, by definition, the wall crossing is not a public domain procedure. It's private. Nobody knows that we wall cross these investors. Only the people that they sign the documentation. And of course, the client that authorized the use of the wall crossing procedure. So in other words, the market doesn't know that few investors have been wall crossed. It's highly confidential, and that's why you need a cleansing process if you don't launch the transaction, because you need to clean up those investors that have been hinted with private information. Okay. I hope you have a nice day. I hope you enjoyed the session. Next session will be on capital increase and the right issue. So far we have done the IPO and the accelerated book building offerings. Next step is the right issue. If there are no more questions, I wish you a good day and see you tomorrow. Thank you. Grazie.